Equity markets and bond markets are on the rebound. It may have gone somewhat unnoticed, but over the last couple of months, the S&P 500 US stock market up 12% over the last 2 months. And if you look at bond markets, US treasuries, for example, 10-year treasuries were yielding 4.3%. That yield has dropped down to 3.5%, which means bond values have gone up. So equities up, bonds up over the last couple of months. I mean, this recovery has been fueled by some inflation expectations coming down marginally, which means interest rates may not go so high. So being broadly positive. Now, normally we would spend this update talking to the fund manager, this week it's Guillaume, about a news story that caught our eye. Instead, this week we're going to do something different. I was prepping with Guillaume for this call. We were talking about news in the media, and Guillaume started talking about why 2022 was a really interesting year for highlighting some key investment lessons. And I said, why don't we park the story of the week and talk about this instead? So Guillaume, you had 3 lessons that you outlined to me, and I think it would be really useful for you to share them with the listeners. So let's get cracking. Lesson 1.
Yes, Shane. Lesson 1 is markets will often recover before the news gets better. As you mentioned, we've seen, good market performance over the last few weeks. But if you read a newspaper, you'll still struggle to find a positive story. Headlines still dominated by high inflation, high energy bills, and pretty tough period for people generally. But we have to remember with markets that they tend to quickly look to the future and they can react positively, even if the news is still bad, but just slightly better than expected. So we'll see if this rally continues. But to me, it's an important reminder that market can bounce hard and quickly. So sitting on the sideline, waiting until things are calm and rosy can often end in missed return. So, trying to time the market ultimately can be very costly.
Yeah, agreed. And I mean, COVID was another great example of this in 2020 when the market fell so sharply at the beginning of the year. In March, we were sitting locked up, no vaccine, all that kind of stuff. And then market started to recover and went on this huge rally over the next 12 months, despite the fact that the news remained pretty negative. Okay, that was lesson number 1. Lesson number 2.
Well, lesson number 2 is that you need to keep looking for true diversification. 2022 has been very tricky with both equity and bonds falling together. And really, it's highlighted how important it is to try and remove, as much as you can, remove bias in your portfolio. So, for example, in the UK, we've got some funds with large exposure to UK fixed income really suffered in September and October around the mini budget sort of blow up in gilt yields. And that really highlighted why a global approach to building portfolios is sensible in this environment. But even with global portfolio, what we've seen this year is that you could have some portfolio that are heavily invested in US tech or have a very high growth bias. And, those funds have had very strong returns over the last few years, but pretty sharp fall this year. So the message here is that you really need to think carefully about diversification and try and keep that balance in the portfolio at all times.
Yeah, agreed. I mean, I think the point on global equities is interesting because you're right on the face of it. Some global equity funds did really well in the last few years, and what this year has highlighted is that some of those same equity funds had a pretty big tech or growth bias. And while it was a massive tailwind in the previous years, this year it's been particularly painful. So looking out for that growth bias and any bias in the portfolio makes total sense. Lesson 3.
Lesson 3 is be patient, but that doesn't just apply with equities. We sort of know the lesson here, but this also applies to bonds. It's all about sort of trying to create wealth over the long term. And when we see what's been happening to bonds with yields going up, it's actually made forward return for fixed income assets actually much more attractive. So remaining invested, being patient, will actually enable investors to gather that income over time. So effectively, it's positive environment for bonds now.
Yeah, no, I agree. I mean, there's a lot of pain being taken with bonds. And I think the point about being patient now and getting that income that's a bit more attractive makes total sense. And we generally talk a lot about equity remaining patient with equity markets, but the same is obviously true for bonds as well. That's great, Guillaume. 3 excellent lessons. I think it was wise to park the story of the week and focus on these lessons because they are really important. We will be back next week. We will be doing something slightly different. It is our year-end special episode, so we'll be hearing from a number of different contributors. So please do dial into that. Until then, take care.